Welcome to Growth Investing Mastery. Here we'll be reviewing my February 2025 mid-month portfolio. Just keep in mind this is not investment advice, not recommendations, and I'm not suggesting you buy any of these stocks. Here's my portfolio allocation as of today, and I have 10 stocks, and my first stock, my highest allocation is AppLovin, symbol app, with 23.7%. My second stock is Hims and Hers Health, Hims with 19.8%. And as you can see by my allocations, I'm a bit top heavy on App and Hims. They've both had big run ups recently, which is why they've grown to this larger percentage. And next is Reddit, RDDT, with 15.6%. I have Astera Labs, ALAB, 14.9%. Paymentus Pay is at 10.9%. And as you can see, there's a drop off after my top five stocks. My top five are my highest conviction positions. At the number six spot, we have Credo CRDO with 5.4%, followed by Zeta Global. Zeta is the symbol with 4.1%. Next, we have Gene DX WGS, and that's at 2.6%. Biostem BSEM is at 2.4%. And Raspberry Pi RPI .L, and the L means it's traded on the London Exchange. That's at 0.8%. I've been tracking my results since the start of 2024, and in 2024 I had a 146% return, which is obviously very strong. And in 2025 we're up 25% so far. So that's a cumulative return of 208% since January 1st, 2024. And I think this 208% really demonstrates the power of compounding returns, where even though you're adding only 25% to the 24 return, since there was a big return in 24, it's adding up to a much bigger percentage here. My main changes during the month have been to trim AppLovin and trim Hims and Hers Health. This is primarily because both stocks have had a very large run up, and as you saw in the previous slides, these are my top two companies in terms of allocation. My conviction's really high on these companies, but I don't want to let them grow too big, as AppLovin got close to over 25% recently. And I used that money to add to other higher confidence positions like Astera Labs and Paymentus. And then I also built out my smaller positions a little bit more to kind of distribute that money evenly between some ideas that they're not as high confidence, but they're maybe newer companies that I'm getting into. And those are Credo, Biostem, Zeta Global, and Gene DX. My top conviction and highest allocation stock is AppLovin, symbol APP, with 23.7% of my portfolio. The company does ad tech and free to play games. If you've played a mobile game or tablet game on your phone or something like this, you've likely seen ads, and those are generally served from AppLovin, which has a near monopoly in the free to play game space. The company has an e-commerce pilot, which is going extremely well, and their next step is building out self-service automation, which will allow the advertisers to basically host the ad or set up the ads as they like. And some interesting quotes in the last conference call indicating how strong the demand is for this product. They said, demand from advertisers wanting to join our platform is high. Long lines out the door. And one thing about AppLovin is if you compare it to any SaaS company on metrics, AppLovin stands out really well. And here we're going to review their earnings guides versus the actuals where they landed. So on the previous quarter, they had guided revenue would be 1.24 to 1.26 billion. And they beat that guidance. They landed at 1.37, which was up 44% year over year and 15% quarter over quarter, or sequentially it's called. And the company had guided for adjusted EBITDA of 740 to 760 million. And they beat that very significantly, landing at 848, which is up 78% year over year. Again, extremely strong. They had predicted that adjusted EBITDA margin would be 60%, and it came in at 62%. Additionally, they gave new guidance, the revenue at 1.355 billion to 1.385, and that would be 31% year over year, which is actually down quite a bit from 44% over a year. But typically, we've seen AppLovin beat their guidance, and a lot of companies are sandbagging on this guidance. They know they can beat this number. And AppLovin gave an adjusted EBITDA estimate of 855 to 885 million, which would be a slight tick up from the EBITDA of this current quarter. They gave the EBITDA margin projection as 63 to 64%. So that's always nice to see margins going up from one quarter to the next and beating their margin guidance. Hims and Hers Health, ticker symbol HIMS, is my second highest allocation position at 19.8%. The company is a telehealth provider offering personalized care. And this means that you can order health products off their medications, and they have a lot of different form factors where you can order the medication, whether that's like oral as a pill, or in some cases with GLPs, you can inject them. And recently they've expanded to GLPs, and that's being served out to most states. They own the pharmacies through previous acquisitions, and this allows Hims to produce their own products based in the US, it's sourced in the US, and all their products meet FDA and good manufacturing standards for compounding. And this is a common misconception about Hims, is that they're unregulated, that they're some junk provider of medication. But as I've looked into this deeply, they own the pharmacies, they work closely and deeply with the FDA. They comply with this manufacturing process. I think the acronym CPMG or something like this. And additionally, Hims can sell brand name, generic, or compounded medications. So if we're talking GLPs, this means they can sell Ozempic, they can sell generic GLPs, or they can sell their own compounded Hims. It's called semaglutide, I believe, which is the underlying component in most GLP drugs. And the company reports earnings on February 24th. What's interesting is the company has had a huge run up these past few days, going from maybe $45 a share all the way up to $63. So there seems to be some anticipation for a very strong earnings report with this company. Reddit is the next company we're going to discuss. The symbol is RDDT, and that's at 15.6% of my portfolio. And until recently, this company was closer to 20% of my portfolio. But what's happened is other stocks have risen, and Reddit went down a little bit after its earnings. And we'll discuss that aspect too. The product is social media centered around communities. And I'm guessing most listeners have used Reddit before or heard of it. If you search Google and you put Reddit at the end, you'll get the subreddit where you can explore that topic. And it's a bit different than Instagram or Facebook, which is centered around users and DMs and things like this. Although you can do DMs on Reddit. There's a lot of underutilized ad space. So the company is always talking about, they've been trialing putting ads and comments, and they really haven't ramped that up. So I view that as a lever for the company to use if they want to kind of increase revenue and profits. One really interesting initiative Reddit has is translations of posts, and this creates new ad real estate. So, for example, they're translating English posts to French, which was their first language, and the entire Reddit corpus is available in French. So what this allows is French people can then read the entire, data set of Reddit, whereas maybe if they weren't that fluent in reading English, they would struggle with that. So profitability is growing significantly, and I noted that expenses remain in check. This is really interesting because, and what you want to see is Reddit has a 92% gross margin, and their expenses aren't rising nearly as fast as revenue is. So it's almost a very tiny percentage that expenses are going up. Although they did mention they are hiring a lot from universities recently. Reddit has partnerships with AI and financial companies to learn from data. So OpenAI and Google are paying Reddit. And these are kind of custom deals. Basically, what Reddit does is they anonymize the data and they sell it in bulk to Google. They did mention on the last earnings call that most AIs were actually trained on Reddit data before they kind of locked things down. So Reddit used to be quite open and people could crawl it, and learn from data science algorithms on it. But they've locked that down a little bit. They realize how valuable their information is, especially with AI, and there's not as much human generated content coming out from some spots. So Reddit's kind of that last bastion of human discussion where actual people are discussing what's going on. On their last earnings, they had previously guided for 385 to 400 million of revenue, and they landed at 428 million of revenue, which is a decent sized beat. That's up 71% year over year. Adjusted EBITDA, they had guided for 110 to 125 million, and they came in at 154 million, which is a very strong beat. So the reason that Reddit was most likely down after their earnings is the guidance. They guided for 360 to 370 million of revenue. While it's up 52% year over year, it would be sequentially down as they just came in at 428 million and they're saying, oh, we might get 370 million. So that almost seems like a very red flag for a growth stock. But actually, there's a lot of seasonality to Reddit, as Q4 is a big quarter and Q1 is a slow quarter, especially as there's seasonality from the shopping season and other things which come in the fourth quarter. So Reddit's a recently public company and they haven't lapped this year over year or quarter four to quarter one yet. So I think the market was a little surprised by the guide, which seems kind of bad. But when you consider it's 52% year over year and they're likely going to beat that, maybe I'm guessing they may come in somewhere around 410 or something like this, which would again be in that 70% year over year range. I think it's basically fine. It was somewhat concerning at first, but I'm good to continue holding a large position here. The next company I own is Astera Labs, A-Lab at 14.9%. They make AI hardware which addresses system constraints, and the company has said all hyperscalers are customers of Astera. And I put all in quotes because that's what the company is saying. But basically, they work with Microsoft, Amazon, Google, and all these other hyperscalers, NVIDIA too, to build out customized hardware so they can do either AI or other applications which require high performance computing. So their products are in data centers a lot. They have a lot of design wins. And they also recently replaced Broadcom in this UA-Link consortium, it's called. It's a competitor to NVLink, NVIDIA's NVLink. Astera has a software-driven approach that allows for advanced diagnostics. So they can figure out things about cooling, data, memory, and thermal issues. So many systems are underutilized for GPUs in the data center. Even with a top-tier Blackwell from NVIDIA, it's basically being used about 50%. The chip is 50% used. So Astera products can help diagnose some of those issues. There's a lot of setup for Blackwell too in the data center. It's needs cooling, potentially water cooling as opposed to air cooling. There's data bottlenecks, memory bottlenecks, and then systems are overheating in some cases, which requires them to either be spaced out more, and that helps Astera because a lot of Astera's products are connecting different racks together basically. They have two product lines, Scorpio and Leo, which are in pre-production with significant design wins. And while they have a little bit of revenue from these designs, it hasn't really hit scale yet. And I expect these products to come online. So Scorpio is supposed to be this year. Leo's a little bit later, but that's going to add a lot add a lot of revenue once those come online. So revenue increased 28 million sequentially, while operating expenses were up only 5.1 million. So the revenue is up over 5x what the operating expenses are. And that's a really nice sign because that means like they're moving to profitability a lot faster than expected. And on this latest earnings report, I thought it was a good report, but the market was down about 10% on it. So they had projected revenue of 126 to 130 million of revenue, and it landed at 141 million, which is 179% year over year and 25% quarter over quarter. For any other company, they would be up massively reporting a number like this, but Astera has pretty high expectations priced into it. It's currently about a 13 or 14 billion market cap, but it previously got up to close to $150 a share, and it trades at 90 right now. And they had gone down when the DeepSeek news came out, but after reading the conference call, I think that DeepSeek fear is a bit overblown. So for adjusted EPS, they had expected 25 cents to 26 cents, and they landed quite a bit ahead of that with 37 cents. Although they did mention on the call there was a one-time benefit, I think it's related to taxes. And this number would have been, I forget what they said, but I think it's closer to 30 cents. So they would have beat EPS by just a little bit as opposed to a lot, the way that makes it look. And for the gap EPS, is they were projecting 4 cents to 6 cents, and that landed at 14. But that's also benefiting from that one time thing. So we're probably looking at 7 or 8 cents of earnings there. The guide they gave is 151 to 155 million. That would be up 138% year over year, or 10% quarter over quarter. And I think this may have been what the market didn't like on this report, that they're only projecting going up 10% quarter over quarter. So last quarter was 141, and if they came in at the top end at 155, that wouldn't be that big a step up, right? But historically, this company has beat expectations by quite a lot on every earnings call. So I'd be surprised if they even got anywhere below 160, and it's more likely they'll probably land 170 or above. Well, maybe 165 could be a possibility as well. But they're definitely going to beat this, like if things are on track. I would be concerned if they can't make that number. So they projected adjusted EPS at 28 cents to 29 cents, a slight step up from the last quarter, but GAAP EPS was projected at 3 cents to 4 cents. And that is actually a slight concern of mine. If you see on the previous quarter, they were projecting 4 to 6 cents on lower revenue. So I'm not sure why they're projecting a lower EPS here. I'm not overly concerned, but it's something to watch out for. And then they should definitely be beating that number when they report next time. My next highest allocation position is Paymentus, symbol PAY with 10.9%. They enable enterprises to set up bill pay. So for example, a bank might want to set up different billing options. And there's so many new billing options available in recent years. For example, there's Apple Pay, Venmo, credit card, bank transfer, and there's so many new apps and things that let you pay. And what Paymentus does, it integrates all those payment apps so that the end customer can just pay pretty much in any way they want. And previously, big corporations used to like to set up this payment stuff themselves. They wanted the control, but the complexity has skyrocketed on all these new payment methods, and they'd have to do so many integrations to support things. So most companies are now looking to outsource this, and Pay is a very big beneficiary here. Revenue is growing 52%, and they're already GAAP profitable, which is nice. They've been able to keep operating expenses in check, which is unlike other SaaS companies, which have operating expenses that cause them to be GAAP negative. The company has a pretty attractive valuation. The market cap is only 4 billion for quarterly revenue of 231 million, and they had a net income of about 14 million as well. They mentioned on the call there's very strong pull forward on enterprise customers last quarter, and I'm looking to confirm that trend. Basically, I want to make sure that it wasn't a one-time thing where everybody signed up early and now their Q4 is going to be poor because all those customers landed in Q3. So we're really hoping for an outperformance on this next earnings, and that earnings report on March 3rd is going to depend a lot about where this allocation goes towards Paymentus. Credo is my next position with the symbol CRDO, and that's a 5.4% position. And now we're getting into the medium and low confidence positions. As you can see, there's a big drop off in allocation after I get through my top 5 positions. Credo builds AI components for data centers. They gave incredible guidance this past quarter, expecting revenue to be up 67% at the midpoint. They guided for operating expenses to be up only 10%. So when you have a company which is guiding revenue for 67% and operating expenses are just ticking up at 10%, that can present a very attractive opportunity. I have some cautions here because the company is based out of the Cayman Islands. They sell into Asia and the Chinese market, and they violated export controls once in their, which they mentioned in their IPO prospectus. I believe they paid a small fine for violating those controls, but it's something to keep an eye on, that the company could, get in a little more regulatory hot water potentially. And this company, it's a little different than Astera. Like they have lower margins, they do more on the hardware side, but their product's selling very fast, and there's incredible demand out of Asia, which Astera doesn't have a foothold in. So I like owning both of these, although I would prefer Astera if I had to pick one. The company is reporting earnings on March 4th. And that'll be really interesting to see where they land if they get, above that 67%. And the real question is where they're going to guide to next. That'll determine if I want to increase this position, hold it, sell or reduce it. Zeta Global, symbol ZETA, comes in at 4.1%. And this is a newer position for me. The company does AI powered marketing technology. Revenue is growing 42% year over year, which is quite impressive for a SaaS based company, as most SaaS companies are growing in the 30% range. They went public in 2021 and they're a lesser known company, which can present some upside or opportunity for us growth investors. The company had some really interesting quotes about AI agents on their last conference call. Adoption rate of our AI agents is bigger than anything I've seen us do as a company yet. And they said they're able to put out an AI agent that can eliminate 10 data science jobs where the jobs were paying $250,000 a year, or that they can eliminate very high qualified data science jobs just by using this product. The company has an attractive valuation at a 4.5 billion market cap and 268 million of revenue. They report earnings on February 25th, and I'll be awaiting that result to see where I proceed next. GeneDx, WGS, is the next company I own at 2.6%. They do gene diagnostics, helping discover rare conditions. Revenue last quarter was 77 million, and that's up 44% year over year. They pre-reported a strong revenue number of 92 million, when the previous guide implied they would land at 80 million. The company is getting close to GAAP profitability, which is always nice, and they have additional potential TAM, or total addressable market, in the NICU and pediatric space. They have a really beneficial mission, which I like. It's to discover the diseases much earlier, and that leads to less misdiagnosis. They've talked about on their conferences how the average child gets misdiagnosed 3 times before they discover the actual condition or disease they may have. And this company is reporting on February 18th next week. So again, a lot will depend on what they're saying in that call. I'm going to review that company in depth. BioStem, symbol BSEM, is my next company at 2.4%. They do healthcare for treating wounds that won't normally heal from traditional care. The company has enormous revenue growth and gross profit, as their product really just ramped up in the last year. Revenue is growing 1,702%, and that's not a typo, and gross profit is growing 811% year over year. Keeping in mind the company just launched, so those numbers, even though they look outrageous, they're actual. There's robust adoption of the products. The market cap is very tiny on this company. It's 246 million, and I think it's down even a little bit since then. Revenue is 82.6 million, EBITDA of 9.3 million, and net income of 6.8 million. The company pre-announced revenue of nearly 103 million with a 96.5 gross margin. Source material for patches and wraps is practically free, as the material for creating their product comes from a placenta which is discarded after a live birth. Typically the placenta is discarded, but in this case they use that material to actually build the wound care product. This company is extremely risky though, because they're listed on the pink sheets and they've been trying to get NASDAQ uplisted. They applied back in September, and from everything I've seen with their investor relations page and their filings, everything looks on track, but that is a big risk. And they had said they were on the pink sheets originally for lower regulations and less reporting requirements. I'm hoping that's the case and that it's not some like fraudulent thing, because there's always a risk with the pink sheets is a little less regulated. And if this company is actually legit, which I hope it is, and they have all this income and revenue, the market cap could go up quite a lot, especially if they get NASDAQ uplisted. The final company which I own is Raspberry Pi, RPI.L, and the L indicates it's listed on the London Stock Exchange. This is a 0.8% position, or a very low confidence position right now. They sell small computers and microcontrollers. And you may have heard of the name. They started out in the hobbyist and educator market, often teaching C++ or programming to younger people. And they've been able to move upstream and serve in the industrial market. And now the industrial market makes up 70% of revenue. Revenue is up 61% year over year, which is quite impressive. They're already profitable, and they have a small market cap at 1.4 billion pounds, and they measure in pounds because that's their currency there. The company is listed on the London Stock Exchange, as I mentioned. And one interesting thing to know is they report in halves, not quarters. So you'll see H1 and H2 is half one, half two. And that is an actual thing on the London Exchange where the requirement is you have to report each year twice as opposed to four times on the NASDAQ, for example. And if you're really interested in this company, it makes sense to get your order routed to London through the broker. And you have to pay a 0.75% fee, which is quite large. And that's on both buying and selling. So if you buy and sell, it's going to be 1.5% total. The company does have a pink sheet symbol, but the bid ask is very wide. When I was looking at the bid ask on it is, $8 bid and $10 ask. That's too wide. You're better off paying the fee if you want to get in on this company. But because it has a large fee, I'm treating it more maybe like a VC investment. I'm not planning to cash out in between earnings or anything like that. So I'll see what they report. I had actually put on here they're reporting late February, but now it looks like they're reporting at the beginning of April, so 1 month later. And we'll see what they report for that. It's going to be called H2 of 2024, the second half of 2024. The last thing we're going to look at here is the upcoming earnings calendars for my companies. So far, I've had 3 companies report this season, so there's still a lot of companies to report yet. And the first one reporting is GeneDx on February 18th. And I'm noting that's pre-market, as most companies report after the market closes, but GeneDx reports pre-market. After that, HIMSS reports on February 24th, and Zeta Global reports on February 25th. There's a couple companies reporting in early March, which are Pay and Credo. And then after that, there's basically a month break until BioStem reports early April and Raspberry Pi reports on April 2nd. I'll likely be making changes to my portfolio based on what these companies report. And if they have strong reports, I'll be likely adding or potentially trimming as well if they become too big a position. But for the smaller companies in my portfolio, I'll probably let them run. And if the allocation gets too high, then I might trim. So that's my plan for now, and stay tuned for more updates. Thanks for listening.